السلام عليكم ورحمة الله وبركاته. Managerial Accounting Chapter 5 Cost Volume Profit. Now, learning objective number 5 determine the sales required to earn target net income and determine margin of safety. As applying to break-even point, target net income and margin of safety. Target net income means level of sales necessary to achieve a target income. If we want to realize net income next year, $1 million, how we can determine the sales required to achieve $1 million net income? For example, can be determined for each of the approaches used to determine break-even sales or sales units or sales dollars. As we learn the three methods in the mirror recording, now we can apply them again to determine the sales required to earn target net income from a mathematical equation by using contribution margin technique or from cost value profit graph. Target net income we can express either in sales units or in sales dollars. To achieve the sales required in units or the sales required in dollars to achieve target net income. Now here's the way to calculate target sales and required sales. Formula to sales to meet target net income. Formula for required sales to meet target net income has sales less variable cost less fixed cost equal target net income. In the last recording, when we compute break-even point, the result here is 0. But now we will record the desired net income, for example $1 million, and to calculate the required sales. Now the same class, but we add here target net income 120,000. Here's the data. We want to determine sales volume Q to realize target net income $120,000. Here's the equation. Required sales 500 times Q less variable cost 300 times Q less fixed cost 200,000 equal target net income 120,000. So Q will be 1,600 units. Mika can use or find the Q using this equation. Fixed cost plus target net income divided by unit contribution margin. Quantity equal fixed cost 200,000 plus target net income 120,000 divided by unit contribution margin 200. 200 unit contribution margin is the difference between selling price and variable cost per unit. Contribution margin to determine the required sales in units for a video in units as you see in this way. Sales in units. To achieve target net income, we can determine the required sales in units in this way. Fixed cost plus target net income divided by unit contribution margin 200 equal 1600 units. The same as you see here. Quantity, fixed cost plus target net income divided by unit contribution margin. Formula for sales in units using unit contribution margin. Now, to determine the required sales in dollars, not in units, here's in units. We divide by unit contribution margin. But when we want to record sales in dollars, we divide by contribution margin ratio. Contribution margin ratio 40%, which is 200 divided by 500 equal 40%. So fixed cost 200,000 plus target net income 120,000 divided by 40% equal 800,000. So target net income, we can achieve target net income if we reach the level of sales $800,000. Also, we can determine target to achieve target net income using the graphic presentation. Suppose a video sells 1,400 sales funds. Show that a vertical line drawn at 1,400 units intersect the sales line at 700,000. If we realize sales 1,400, here's the sales will be 700,000. Also, in this level, total cost here, the line will be 620,000. So the difference between 700,000 and 620,000, the difference is net income or a profit $80,000. We can determine the net income in this case $80,000. Multiple choice. The mathematical equation for computing required sales to obtain target net income is required sales, as we learn here, target sales will equal variable cost plus fixed cost plus target net income. Target sales equal variable cost plus fixed cost, that target net income. from this equation, the answer is required sales equal variable cost plus fixed cost that target net income. Required sales on one side and the other items in the second side equal variable cost plus fixed cost that target net income. Here's margin of safety. Difference between actual or expected sales and sales at the break-even point. Margin of safety. Measures the equation that a particular level of sales profiles may be expressed in dollars or as a ratio. Now, margin of safety. If you expect to get 80 points in managerial accounting, so you can determine the margin of safety with the difference between 80 points and the bus point 60. So the margin of safety, you got 20 points, or as a ratio 20 divided by 80, it's 25% margin of safety in your study this course, managerial accounting. You can apply this idea to your course, managerial accounting. Margin of safety. Difference between actual or expected sales and sales at the break-even point. Let us say that break-even point or the bus point 60. So if you expect to realize to get 80 points, so the margin of safety you got 20 points as points or marks. We can calculate it as a ratio, which is 20 divided by 80, 25%. Again, this cost value and profit analysis, we can analyze margin of safety. Difference between actual or expected sales and sales at a break-even point may be expressed in dollars or ratio. Now, if we assume actual or expected sales are 750,000, in this exercise, for this exercise, for this data, we can determine margin of safety. Actual or expected sales 750 is given minus break-even sales for the previous exercise 500,000. So margin of safety in dollars 250,000. So if our sales, if the actual sales decrease to 250,000, we have equation before we reach break-even point. Before we begin to realize losses, margin of safety in dollars 250,000. It's very important, this data. In this case, if the sales decrease to until 250,000, it's okay, we still realize profit at least not realized losses. Now, margin of safety ratio, we can compute it as a ratio computed by dividing the margin of safety in dollars by the actual or expected sales. The same thing, assuming actual expected sales are 750,000. So margin of safety in dollars, as we determine in the below slide, 250,000 divided by expected sales 750,000 equal margin of safety ratio 33%. If the sales decrease by 33%, it's still okay. We didn't realize losses. This is very important. The higher percentage, the greater the margin of safety. The higher the dollar or percentage, the greater the higher the dollar or percentage, the greater the margin of safety. Now, a multiple choice, Marshall Company had actual sales of 600,000 when break-even sales were 420,000. What is the margin of safety? Ratio. Margin of safety ratio. First, margin of safety, the difference between 600,000 and 420,000 equal 180,000 divided by the expected sales 600,000 equal 30%. First, we calculate margin of safety, the difference between these numbers, 180,000, then we divided by 600,000 equals 30%. Break-even, break-even margin of safety and target net income. Do it is easy. This very important exercise. You can meet as this exercise in quizzes, in midterm, in final exam. It's suitable for midterm exam and final exam. As incorporation makes target bags, makes travel bags that sell for $56 each. This is the product the company sell, travels bags. This is the units, the product we sell, travel bags that sell for 56 each for the unit. For the coming year, management expects fixed cost to total 320,000 and variable cost to be $42 per unit. Compute the following. As you know, this fixed cost from manufacturing and selling and manage and the variable cost for manufacturing and selling and administrative. Compute the following break-even point in dollars using the contribution margin ratio. The contribution margin ratio, as you see, the contribution margin ratio, first of all, the contribution margin, the difference between the sales price 56 less variable cost 42. The difference here is 14. The difference then we divided by 56 sales price equal 25%. Here's the contribution margin ratio will be 25%. Then the break-even sales in dollars equal fixed cost 320,000 divided by 25% equal 1,280,000. Here, number A, to calculate break-even point in dollars using the compensation margin ratio. Contribution margin ratio equal 56 less 42 divided by 56 equal 25%. Contribution margin ratio 25%. Then break-even sales in dollars equal fixed cost 320,000 divided by the ratio 25% equal $1,280,000. Now in B, compute the following. B, the margin of safety and margin of safety ratio, assuming actual sales are 1,382,400. In B, we need to calculate margin of safety. Also, we need to calculate margin of safety ratio. Two things. Here, margin of safety will be expected sales less break-even sales. Margin of safety is the difference between actual sales or expected sales 1,382,400 less break-even sales from A. Break-even sales in A, which is $1,280,000 equal margin of safety equal 102,400 equal here's expected sales less break-even sales 1,280,000 80,000 equal 102,400. Margin of safety ratio will be the margin of safety divided by expected sales divided by the expected sales equal 7.4%. Margin of safety ratio. Here's margin of safety is the difference between actual sales and the break-even sales. Margin of safety ratio equal margin of safety divided by expected or actual sales 7.4%. And C, the sales dollars required to earn net income of 410,000. Again, required sales in dollars, we add for fixed cost plus target net income divided by the contribution margin ratio, we got the required sales. So we will begin next recording exercises for chapter 5. Assalamu alaikum wa rahmatullahi wa barakatuh.